Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Mark, happy Friday. We're back with another episode of Digital Current, ABCD Roundup. How are you doing?
Doing great, X. And happy Friday and happy fall to everybody. You know, we made it to October, you know, in circles of Bitcoiners. They were calling it Uptober, but it didn't start that way, which we'll talk about. The quick reveal, I'm actually in the office today instead of the home office, but so it's a little more precarious to get up here, but I do have the orange pants, and I have the, I broke out the Bitcoin roller coaster sock game. Even though summer is over, we've got an Indian summer going on here in North Carolina. It'll be close to 80 degrees. Sun's finally back. Man, I tell you, I felt like I was living in Ireland. And look, we didn't get touched by the hurricane, and you know, hearts go out to all the people in Western North Carolina that are truly suffering. And shout out to CoinDad. He's a North Carolinian Bitcoiner who loaded up 4 flatbeds full of stuff, drove the 4 hours, and then took ATV runs up into the mountains to get people. So he met this one family that hadn't had water for 3 days. And you can't appreciate the suffering that's going on unless you've lived through it. And part of it is we all take for granted how close to the edge we live, right? I mean, think about if your grocery store didn't have any food.
Yeah.
Do you know where the next closest grocery store is? Maybe. Think if your gas station didn't have any gas or couldn't turn the electricity on to get the gas out. And I had a similar, not as dire experience. We had an ice storm here maybe 15 years ago, and we didn't have electricity for 7 days. And it's winter, right? Because it's ice. And the first couple of days, no problem, right? You got firewood, you can keep the house warm. Third day, you run out of firewood. So then the house starts getting, like, just a 60. It's uncomfortable, but it's not bad. Gets to 50, you're like, all right, what do we do? So we had a gas water heater. So we literally would run the shower, and that would keep keep the bedroom kind of warm so we could sleep. But then you're starting to run out of food on the 5th, 6th day. And, you can't get out of your driveway because the ice is piled up. And you couldn't get gas at the gas station or food because you couldn't get in the food. So, but it's not dire. But the crazy part is by the 6th day, it's now in the 40s in the house. We're like, okay, this is legitimately uncomfortable. So we're like, all right, we're just going to drive to Virginia because we'd heard they got the power back on in Virginia. And, we pack up the car. We're like, okay, this is probably not the smartest thing in the world, but we just got to do it. And probably by the time we got to the 3rd load to the car, power clicked on. And things were better. So thank you to the electric workers out there in the freezing cold. But you just don't, I mean, we're talking 6 days.
Yeah.
And I don't have a gun and know how to hunt, and there weren't a lot of deer out there. And it just you don't realize how bad it can get until it gets bad. And and we're also lucky to live where we live. I'm not complaining. It's just this is a stark reminder of how close to the edge we really are.
Yeah, I mean, well said, Mark, and that's an incredible story. It just shows that, like, there's a gradual kind of lack of faith in that things will kind of be okay, that you have to take matters into your own hands. You start to fight it off a little bit. I think at one point, human beings, we're all outdoor cats, and then we became indoor cats.
Yes.
We lost all of our survival skills.
Yes.
But over time, those are still somewhere deeply rooted in our reptilian brains that if certain conditions are right, we start to adapt and have to go out. But it's one thing to say that on our own, and the other thing, we've got a family and children and have to kind of navigate all of those things. So to your earlier point about like how October says the October sort of started a little bit lower, maybe we can kind of go back to September, because that was supposed to be the, the down.
That was supposed to be Rectember.
Right. It wasn't, right? It was up about 8%. And it was actually some of the strongest times since 2013. So yeah. I think it topped up around 66,000 to kind of close. It's had a since kind of come down. I think there was a couple of things here that were at play, Mark, right? So first we had the rate cut, which definitely helped matters. We had sort of at least some pandering on both sides of the aisle towards favorability in the crypto side. And of course, this is, I guess, the first one you could say that we've had live trading instruments to more of the mass market in ETFs, and that created a little bit of this flatter line, Mark. As time goes on and on, I'm kind of getting the feeling, I don't have too much data to back this up. This is more my gut feel, that we're going to see a little bit less of these meteoric sharp rises and falls as the currency sort of flows into its own S-curve, right? Well, what say you, Mark, and how do we kind of expect things now for October and kind of this post-halving cycle?
Yeah, so many really important points there, X. One is this idea of S-curves, right? I mean, S-curves are inevitable with adoption of all technologies, whether it was the flush toilet or air travel or radio or television or computers or the internet or blockchains and digital economies. So think about where the internet was kind of 11, 12 years in. It was about 11, 12% penetration, right? The first decade, you get that early adoption. And then the second decade, you get the big part of the S-curve, kind of the 80% of the masses. And then the last decade, you get to maturity. And then the other point you bring up is the volatility piece, which is volatility is always highest, earliest, because all volatility is disagreement about the future state of something, right? There are stocks that have high volatility. It's just because people can't figure out how to value them. A bond has very low volatility because there's not a lot of risk, right? You buy a 90-day T-bill, in 90 days, you're getting paid 99.999999% of the time, if the U.S. government were to fail. But if you take a 30-year bond, that has higher volatility, as we've seen this year, right? Up big, down big, because the duration is longer, because a lot can happen in 30 years. I mean, probably still not going to have a default, but a lot can happen to interest rates and valuations. But in equities or private businesses or now protocols, which are traded between human beings, one human can say it's going to the moon, the other can say it's going to zero. Now, total non sequitur, but how ironic that Brian Moynihan, who spoke at a conference a number of years ago and said, well, Bitcoin is useless because you could wake up one morning and it'd be worthless. He'd be at zero. Bank of America accounts. And I've talked about this on the show.
Yeah.
I have a recurring nightmare, not every day, but maybe once, twice a year, maybe not that, maybe once a year, where you go to the ATM, you punch in your code, and it says zero. Like, how would I prove it's not zero? I don't have a statement. It's their word against mine. It's that trust. Well, this week, people went to their ATM at Bank of America and it said zero. I mean, imagine the panic of going to the bank and the money you thought you had. Remember, it's not your money, it's the bank's money, and they could take it. Now, they didn't take it in this case. It was just a system glitch. But that disagreement between people who believe, like Brian Moynihan, that Bitcoin is worthless versus people like myself and you and others that believe, no, it's digital gold. It's the base layer of digital money, and it's going to be very, very valuable. It means the volatility is going to be very wide. And so the other point you bring up, which I think is really, really important, look, when everyone knows something, it's off the table, right? And one of my favorite lines is, I think it's Mark Twain. Of course, Mark Twain is credited for everything. Well, he didn't say half the things, but it's not what we don't know that kills us. It's what we know for sure that just ain't so. And so everyone was absolutely certain that September equals Rectember, and it was going to be bad. And look, the first 2 weeks, it was bad.
Right.
But no one saw Jerome the shapeshifter turning into Jay the dove and not going 25, but going 50.
Right.
And boom, suddenly you get a big rally. I mean, look, we went from 53K, where people were starting to freak out that, oh my God, it's over. I'm like, are you joking? Over? $53,000 for one Bitcoin? Come on. But went from 53 all the way back into the mid 60s and made this perfect inverse head and shoulders pattern, or cup and handle, whatever you prefer. Broke through the neckline, made a higher low and a higher high, and I think broke out of the distribution pattern. Oh, but then everyone was like, okay, October is here. It's going to be awesome. And then the first 2 days of October, markets were down. Why? Well, because while one Fed governor was saying we're going to do 50 more, Jerome was back. Like, I swear he's two-faced, man. It's like, Jay, oh, I'm going to cut. Oh, no, that's a cut. I meant everything's fine. We're not cutting. And so people freaked. Like, well, wait a second. Cutting 50 basis points should actually make you afraid. You should say, well, why? And in fact, I did an around the world session yesterday on kind of election 2024. And does it really matter who wins? The short answer, if you don't want to watch the whole episode on our Around the World with Yusko YouTube channel, is doesn't matter, right? It doesn't really matter who's president. The economy does what it's going to do. Interest rates do what they're going to do. And it's a whole set of factors that influence markets. So as an investor, you really don't care very much who wins the election.
Mark, what about this point about the expiration of crypto options? So there was about 5.8 billion in crypto options. And we talk about this a lot, in that sometimes, the ETF is claimed to be a barometer for the overall adoption of crypto. And on one side it is, but on the other side, it's really just this smokescreen that allows for an option type of trade. So now we have this expiration of a whole lot of options, and then that's going to bring prices down. So what do you kind of expect for things like that? Because there's so many of these things that are just kind of unraveling.
Yeah. I mean, what's really interesting, as when there was just Bitcoin, literally just Bitcoin, and you had to meet people in the back alley and change, physical money for a physical hard drive. It was a bearer asset, and it was kind of shady, and there was, $5 wrench risk. The partner comes up and clubs you on the head, and they take the money and the Bitcoin. So we got away from that to a market in spot using exchanges and tools. But then we found that, some exchanges, like Two Guys and Their Dog in Japan, bad. Even though it had a cool name, Mt. Gox, the Magic the Gathering exchange. Okay, great. So, but as you evolve into a full-on market, a market with good solid exchanges like Coinbase and Kraken and Gemini, and one with good derivative instruments like futures and options, suddenly you get what all these markets have, which is you get a speculative class.
Yeah.
What do I mean by that? There's nothing wrong with speculation in and of itself, but it's not investing, right? Investing is when you buy an asset below the fair value and you hold it. And then at some point in time in the future, when it's above fair value or you need the cash, you sell it. That's investing. Trading is buying and selling things you don't care about fair value. You don't even really know fair value in most cases. Speculating is two types. There's the traditional speculator that is literally a term. It's like a term of art. It means the opposite of a hedger. Well, what is a hedger? Hedger is someone who produces a commodity, an asset, and needs to sell. So they sell in the futures market. Oil producers sell in the futures market. Bitcoin miners sell in the futures market. And so the speculator takes the other side of that trade. That is a perfectly good function. But there's another term for another kind of speculator. Another kind of speculator is a trader with leverage. Whether it's the embedded leverage of options and futures, where you have to put a small amount of collateral down and you get an embedded leverage, or actual leverage, where you borrow money and buy assets. And so as the number of derivative instruments increase, because people are really smart in the financial services world, they have figured out, and Ken Griffin's like the king of this, he figured out a long time ago, buying and trading options, kind of a fool's errand. It's kind of like playing tennis, right? Winning the loser's game, Charlie Ellis. If you're an average tennis player, like not the elite, but if you're an average tennis player, you should never try to hit a winner, ever, because you're just going to do an unforced error and you're going to lose the point. All you should do is doink the ball back across and let the other person try to hit the winner, and they commit the unforced error. It's so proud.
Mark. They're called the pushers. I hate playing against them.
Oh, I know. And because it's like, it just looks bad, but it's the right way to play the game if you're not a great tennis player. And same thing with golf, right? You should leave the driver in the bag.
Yeah, always.
And you should tee off and you hit it shorter, but you're in the fairway and you're not chasing your ball. But the humans don't. We want to hit the forehand winner or the backhand cross court.
Yeah.
And the problem is you hit 1 out of 10, right? Bad decision with a good outcome. So, but speculating is the same thing. Is in options, 85% expire worthless.
Wow.
85% of the time, when you think I should buy a put, you should buy a call. When you think I should buy a call, you should buy a put. Well, who makes all the money then? The people who write the options. Ken Griffin, people who trade the options and take a little piece. And so to your point, the options have gone like this. There's more options in the stock market. Options trading is all the rage, and people have more, 24-hour settlement options than they do underlying positions. That's all just pure rampant speculation. And the problem is the house wins.
Yeah.
Now, unless, and this is the Danny Ocean quote, right? Yes, the house wins unless you don't bet every time. You wait for the perfect hand, and then you bet big. And, Brad Pitt's like even rehearsing that. You're like, oh, yeah. Did I rush it? You're like, but that's the key, is the house is always going to win unless you get that perfect hand. And there are times when you get the perfect hand. And in this market right now, I think there's a push me, pull you, the Dr. Dolittle two-sided llama.
Yeah.
That is the tension between the hodlers, who are like, you're going to pry the Bitcoin out of my cold dead hands and I'm not selling, and the future sellers who are like, I don't really give a crap about Bitcoin. I just know that if I sell the future, I can make a spread over the spot and I can roll down the roll yield. And so I see the crypto Twitter blowing up like, who's selling their Bitcoin? Who is against the league of hodlers? Like, no one's selling their Bitcoin. Not no one. But it's not that. It's the futures market and now this options market, which exacerbate the volatility through embedded leverage of the tools.
Yeah, of course. Well, it's perfectly well said, Mark. And of course, there are always these short-term shocks that when you have more of the speculation exacerbates what we're seeing. Obviously, tensions in the Middle East resulted in $3 billion getting sent to exchanges at a loss. And then, of course, that created, a decline of like 3.7%, which kind of snowballs with all these other things and confounds a little bit of these variables. So it could be very difficult for us to approximate.
No, that's another important point. I saw someone tweet this that I'm never going to say post, Elon, ever. I'm going to say tweet. It's Twitter, not X. Your X.
Yes, there's one.
There's only one. So I saw this guy say, see, this is proof that Bitcoin's not a store of value because when the missiles started flying, Bitcoin went down. Oh my God. Okay.
Yeah.
Markets 101. When you have a surprise, whether it's a geopolitical surprise, a financial surprise, whatever the surprise, the people who are levered are caught off sides.
Yeah.
Okay? So if you're levered long, and the missiles start flying and your stuff goes down, okay, you now get a margin call. In a margin call, so let's say you had a stock, this suddenly gapped down 10% overnight because people were worried about geopolitics, and you're levered up 10 times, so now you've lost all your equity, and you have to post more collateral. You can't sell the asset because it's not worth as much as you need, and so what do? You sell what you can sell. Cash, bonds, gold, Bitcoin. So in shocks or surprises, those assets fall. And because some people are levered, they might fall even more. And you can go back to 2020 when the lockdowns happened, Bitcoin collapsed 50% in like 12 hours. And I remember people freaking out and saying, oh, it's over. We got to sell. It was $5,000. And obviously the smart people backed up the truck. And it's significantly more than that today. But for a few minutes, it was $5,000. Or oil prices. Oil prices went negative for a day. But who was the smart people? The people like Saudi Arabia that went out and bought 10% of Royal Dutch Shell and BP. And so in those times of stress, yes, the assets that you don't expect to go down, go down. But if you have cash and you can buy the dip, that's a really good thing. If you just say, you know what, I'm just going to keep dollar cost averaging.
And to that point, Mark, it's been a long while since we had our following chapter of chip wars, which we talked a lot about in the summer. And so this chapter of chip wars kind of touches some of the points that we're talking about in international investment as well as technology, and a little bit of my own, optimistic views about the market coming back around, because this year, yes, we haven't seen as many IPOs, but there have been some significant ones in semiconductors, right? So we saw ARM, we saw Astera, and now there was another one that was declared, Cerebras. They filed for an IPO, and they're challenging the NVIDIA dominance. But who is one of the large investors in Cerebras? G42, which is a big fund out of Abu Dhabi, which is a lot of stuff within technology. And it's very complicated because they also receive a lot of investment, G42, that is, from companies like Microsoft and of other American technology companies. So it's a very interrelated enterprise. But I think what this is really speaking to is a couple of things. AI is not going away anytime soon. So I think we spoke about a lot of Goldman Sachs reports that mentioned while there are challenges into thinking about public stocks that are in the AI world, yes, you do have to make money at the end of the day. You have to realize what your and earnings to multiple values are. But at the same time, this is also a long-term strategic play. Hence, the next chapter of chip wars. You're seeing sovereigns get more and more involved and invested in chips and semiconductors, and I'm expecting some pretty interesting things for Cerebras, especially now they're trying to challenge NVIDIA here. It feels like everybody's coming after them, Mark, and that because they had the word.
Of course. I mean, come on. People, well, part of it is, and it's true forever and always, the people who run the capital at the current time are in the prime of their career. Which means they're young. Call it 30 to 45, 50. All right? Those people were in school during the last cycle. So maybe a couple of them were paying attention, but most of them weren't paying attention to what was happening in the last cycle. And so they don't have the benefit of having lived through that cycle, and they don't have the wisdom. And again, it doesn't mean they're bad people. It just means they just weren't there. And so it's interesting when you get old and you've been through multiple cycles and you're like, I've seen this movie before. And every time some company, and if you actually are a student of history, which I actually think is one of the best things you can be in investing.
That was my undergrad major, and they said that it wouldn't pay off, Mark.
No, it is.
Music to my ears.
I mean, I will argue biology and chemistry are maybe the best, but history's right, and it's probably a tie because although that's so politically correct. But biology and chemistry is all about the scientific method, hypothesis formation. That's what investing is. You form a hypothesis, you do an experiment, you test the hypothesis, you gather data, and then you make a new hypothesis. You're either right or you're wrong. But history, everything repeats.
Right.
And the further back you look, the further forward you can see. So said Churchill. But in investing, it's so true.
Absolutely.
And in 2000, Intel was NVIDIA. Like, I'm not exaggerating. It's not a bad comparison. They were the dominant superpower in chips. Their stock went literally parabolic. It went up 20-fold in a little over a year. And they were on the cover, and they were going to solve AI. Okay? Now, today, that stock is still, 24 years later, down 60%. Because what happened is this little upstart, okay, outpaced them. And we've talked about the evolution, right? A CPU, just simplistically, and this is not exactly right, but simplistically, it processes words, right? And that's how it works. Code, words. A GPU found a way to process images. Like, there's more information in the picture, all the stuff behind me, than if I had to describe it. Well, there's a picture on the wall and a couch and an orange thing, and there's a lot of words. A picture is worth 1,000 words. So you get about 1,000-fold increase. And so Intel went like this and NVIDIA went like this. Well, guess what? TPUs, okay, tensor processing units, take, words and pictures are two-dimensional, but the brain and neural networks and AI are not two-dimensional. They are three-dimensional. They are literally amorphous clouds of nodes, billions and billions of nodes that have to be processed using arrays and vectors and matrices. It's 1,000-fold need. And so there are companies now focused on this basically three-dimensional compute that are going to be the story of tomorrow. And then we'll add time for a fourth dimension. And then maybe we'll add different states like quantum in a fifth dimension. And there's probably even more than I can then comprehend. But all of these things evolve. But if you weren't there, you're like, oh, no one can assail NVIDIA.
Sure. Just like when people say that Google can't be toppled, right? Because they don't remember a world where there were multiple search engines. And I think, with Cerebras, it's going to be the first American IPO since the release of ChatGPT, right? So the world has really fundamentally changed since then. And at that point on ChatGPT, we got to come up with a name for the series. I can't think of one on the spot, but when we're talking about the change in the board composition and the restructuring of the governance model.
Yeah.
Not for a for-profit benefit corporation. We have a new record on our hands, Mark. So it is now marked as the largest VC funding round of all time. OpenAI, their valuation soars, $157 billion, with $6.6 billion raised from folks like SoftBank. They are never a stranger to a large round. Not always a good thing. Microsoft, Thrive, and of course, NVIDIA, we kind of make the mistake in thinking that as a public company.
I wish them well. I really do. I wish them well. And to be fair, people have heard me on this show and other places say that, when ChatGPT was originally released, I thought it was basically useless. I mean, I'd ask her the question, it would give me garbage, it would hallucinate. And I have to admit, yesterday in my presentation, for the first time, I cited ChatGPT, sourced ChatGPT. I let it summarize Trumponomics and Bidenomics because it was able to list the 5 tenets of Trumponomics and the 7 tenets of Bidenomics faster than I could type. And it was 95% accurate and good, and there were a couple words that didn't really make sense, but it was great. That's awesome. That's really cool. But here's the problem. They lost money on both of those queries. Okay? Because the demand for power and compute is still so high because they're trying to do this three-dimensional thing in 2 dimensions, and there's just too much back and forth from the memory to the compute. And look, someone is going to find a way. In fact, we think we found a company that's going to put the compute in the memory. So you don't have to go back and forth. You don't have to generate all that heat, and you can be really fast. We talked to this kid we talked to the other day. And I don't mean kid derogatorily. I mean, he's young. I mean, not 30, I don't think.
Yeah.
From that, University of New Jersey at Durham. I can't say the word. No, I can't. Even though I'm wearing Carolina blue. But one of the smarter kids I've met in a while explaining the next generation of processing using photonics, which the promise of photonics has been around for 20 plus years. Again, I'm old. I remember in 2000, there were funds, venture capital funds, that put 80+% of their money in optical switching companies, photonics-based companies. It went to zero. Zero. Like not, oh, they invented something that's still used. They went to zero. Now, this is a little different play on it, and I really thought his idea, and he's putting the photonics elements onto silicon, which that's amazing.
Yeah.
Because normally you're talking about moving electrons, not light. But long story short, if, and it is still a capital I, capital F, but if his chip works, holy moly, it's going to be a really big deal. But that's the innovation and the youth and the exuberance of, well, why can't I do it that way? Sure, why can't we do this? And that spirit, I mean, one, it's why I love what we do now. It's the most fun I've ever had, because you get to hang out with these people who, the old adage of, if you're the smartest person in the room, find another room. I haven't been the smartest person in the room in 6 years. I mean, I'm rarely the smartest person in the room, but the last 6 years, it's just not close. I mean, and I love it. I love being the dumb guy saying, all right, explain to me again what you're talking about. Because I'm not a techie, I'm not an engineer, but I feel like I've learned so much from these people, and from the process, and the chip wars. Back to your original point, we've talked about this for a while, in that the next war, excluding what's happening with people firing missiles at each other, but the next war, I think, is fought with chips, not ships.
Definitely.
I think the future dominant superpower, or if it's not a superpower at all, if we go fully decentralized, nation stateless, we all kind of live in the metaverse, it's dominated by chips. And do I think we're going to be in a snow crash, kind of everyone goggled up and kind of, not yet, but kind of?
Yeah.
I mean, yeah.
It's already happening now, Mark. So I think another company that is, reminds me of Intel, but they're probably even more in need of a facelift, is IBM, right? So IBM, now they just released their inaugural European quantum data center in Germany. So if you want to talk about rivals becoming allies and wartime, so this is important because you're having, first, the ability to provide direct access to advanced quantum systems for European organizations. Okay, and many of these will be state backed. We'll just kind of come out and say that. So it's going to strengthen research and industry efforts, and they're going to be using the most advanced stuff. So there's 2 facilities that have the idea of 127 qubit Eagle chip, which is just an insane amount of power, right? And so I think this is, showing that we always kind of, I wouldn't say disparage, but we kind of poke fun a little bit at Europe. When we look at the venture markets, we tend not to speak about them that much. We talk a lot about,
oh my gosh, absolutely. I mean,
here they are.
Byron Wien said, and this was 15 years ago, Europe's well on its way to becoming a great open air museum, which it is. I mean, there are a few places I love going more than Europe.
Beautiful
just for the culture and the history and the sites. But yeah, from a technological innovation state, not much there. But most people don't realize that there is a company, European company, that if it weren't for them, none of us could talk to each other because they make all the machines that make all the semiconductors everywhere in the world. I tell you this, I just learned this week that, and I think we're going to be talking about this for a while. But yeah, there's the whole conspiracy theory of how Hurricane Helene got to North Carolina. Now, the fact is it just got there, and just like it did in 1915. So it just happens once 100 years, you get, a turn left instead of right. But there are, the theories on, where there are these space lasers and the government did it because it's red states and they don't want them to vote. And I'm like, stop. But here's an interesting little factoid. There is a place in North Carolina, Spruce Grove, North Carolina, that produces some high 90s. I don't know if it's 98 or 99 it's close to 100% of the pure quartz. And there are a lot of places that you can get quartz, but you need pure quartz, like 99.99999% pure quartz to produce silicon chips, right? You need to make a crucible that you can melt the silicon, and you need the material not to melt. And that's the only thing they found that works. So long story short, it was right in the eye of the storm. And it's going to be a while before they get back online and get the mine working. And I don't know. I don't think a lot of manufacturers had enough quartz in inventory. And so stay tuned for how this story plays out. And, it's funny how there's always a mineral involved. Like you look at Venezuela, and we're like, well, why did we get involved in Venezuela, and why did Maduro get installed? Look up tantalum sometime. Maybe over the weekend. Like, do some research on tantalum and find out where tantalum exists, and find out that in 90+% of phones, you need tantalum or you can't make the phones. Interesting. Just curious. And, it's curious that in Ukraine, there happens to be a pipeline that transports natural gas, right? Again, minerals. And so there's always a funny link to some mineral, right? There's a whole big thing going on over hydrocarbons in the North Pole, right? And I still don't know how you're going to drill in the Arctic because it's cold. But there's a whole bunch of stuff going on about, who gets rights to those minerals underneath the ocean floor. So, and then there's another one about a certain mineral in Antarctica. I'll leave that for another day.
I think it's a good segue that we can turn to in the chart of the week. Now, we found one this week, Mark, that kind of compares different asset classes. We talk about this a lot if we think about the big picture. Maybe folks thinking, the reason that we spend a lot of time talking about what happened in public is because this is incubated in the private markets. So we kind of try to figure out, okay, what's going on here in blockchain and AI? What's going to be the resulting impact when these companies ultimately mature, right? Or take the next step on the S curve. So there was an interesting report compiled actually just today by Hamilton Lane, and they were able to kind of posit a couple of different asset classes and a 10-year annualized weighted return. So I think there are some interesting but not so surprising results for those who have been avid listeners of the show. So I will share the screen and we can kind of talk through some of their findings. So what we're sharing, so Mark, let me know when you can see the screen.
Got it. Well, I can see the screen there. There we go.
Okay, great. So what we're showing here for those that are on audio only, please navigate yourselves to YouTube where you can find not only Mark's stock Bitcoin reveal, you can see it for batching, and of course you can find the chart of the week, which we present every week and kind of talk through the things that we look at to inform decisions like IC and all important investor type of conversations. So what we're seeing is there are effectively 4 different kinds of asset classes, Mark. Now, they have different labels for groupings, but they're kind of the same thing, right? You have a grouping of equities, you have a grouping of bonds, You have a grouping of like overall commodities, so things that we're talking about. And then you have a bucket, which I like to think about as more encapsulating of a venture bucket, which is private infrastructure, which is a lot of the things that we will invest in. So it's showing performance, time-weighted average, has a sharp ratio over 10 years. And I think, to the surprise of nobody that listening to the show, there is one clear winner here, Mark, and that is the private infrastructure bucket. So I will hand you the mic. This is your time to shine and gloat about the things that you've been looking at for a lot of your career, Mark.
Yeah. So look, I say I just had a series of happy accidents and kind of got lucky to find my way into something that I loved, right? Because if you do what you love, you don't actually have to work. So, but I stumbled into investments from right to left on this chart. So on the right-hand side, you see bonds. I mean, this is high-yield bonds, but I actually started in boring bonds, like literally treasury bonds, laddered treasuries. I worked for an insurance company. I was a business analyst. If I were a resume inflator, I'd say I was an M&A analyst, because I was the guy who did the spreadsheets for the acquisitions of the little insurance companies we were rolling up into our insurance company. Literally, I was the only person who knew how to do Lotus 1, 2, 3. It was kind of funny. I mean, had this company, CEO, CFO, had no idea how to use a spreadsheet. I was the only guy. That was my job. So the guy was doing investments, retired. They said, hey, take over the portfolio. So I learned how to be a bond investor. And the thing about bonds, it's the first risk you can take to make a return. So if you leave your money in a riskless asset where the Sharpe ratio is infinite, you get a lot of return a little return with no risk, no volatility. Treasuries, you make the risk-free rate, hence the name, and all that return gets chewed up by inflation. Long-term risk-free is 4, long-term inflation is 4. They cancel each other out, and you don't get any wealthier. So you have to take risk. Well, the first risk you can take is credit risk. You can buy a bond, and bonds are a contractual claim, so you only get paid a little bit above risk-free, on average 2%, maybe 3 points for high yield because they're a little riskier. They default more often. So on the far right, you can see that they have a mediocre return, around 4%. And that's because, remember, risk-free over the last 10 years got down close to 0. Right. So you picked up 400 basis points by taking credit risk. And if you were in, risk-free, you got 0, and then inflation was averaging 2 or 3, you were losing money every year. Horrible. Second risk you can take is equity risk. So second from the right, equities give you about 500 basis points more than bonds. Well, why? Well, because they're a contingent claim. You only get paid if all the bondholders get paid. So when a company defaults, the bondholders get what's left and the equity gets wiped out. So on average, you make 5% more, 7% above risk-free, long-term 11. Here we're about 10. We've been a little lower than average because, again, interest rates were low. And then you got commodities, and infrastructure, they didn't do that well over the past few years because, again, you had risk-free was so low and you're getting a return above risk-free because most of commodities are traded in futures markets and derivative markets, and things like gold and silver and platinum and all the things that you do in global infrastructure, just not a very good business. So on the far left, you get private, and private you get on average another 500 basis points. Now here you only got a couple hundred basis points. Well, why is that? Well, this is just the private equity version. It doesn't include as much of the venture capital.
Right.
Private infrastructure has done well, and it's given you the 500 basis points, 600 basis points above public infrastructure. But the public equity, the world index, actually has more tech, which is kind of the public version of private venture. So if they added the data here on venture, I think the venture return is actually closer to almost 20%. It's actually had a higher than average return over that 10-year period, because innovation as an asset class is extraordinary. So you get a an illiquidity premium, the difference between the Carolina Blue and the Duke Blue. Of course, Carolina Blue is the highest, of course, right? Versus the Duke Blue. And that incremental return is that third risk you can take, illiquidity risk. So, bond risk, it's fine. And, but the Sharpe ratio is not very good. You're not getting a very high return per unit of risk. Equities, again, fine, but your Sharpe ratio isn't that good because there's more volatility to get. Private, you get this beautiful thing. You get a high Sharpe ratio. You get a high return per unit of risk. Now, the doubters and the haters will say, well, that's because of mark-to-market lag and it's not real. I'm sympathetic to that, right? I don't mark my house to market every day. I don't mark my private businesses every day. So even if it is a false low volatility, the reality is the return is not false, right? The return being higher is real. And if you have a long duration asset, a savings tool, you should be overweight private investments. Just as simple as that.
Yeah, I mean, that's so well said, Mark, and I'm glad that we popped this one up. An oldie but a goodie with some fresh data, but ultimately I think you captured a lot of those main points. If you look at this, you might think, okay, like this is, am I really getting compensated for the level of risk in the private relative to just, equities? But I think that's the key point here is that there is a significantly higher Sharpe ratio. And then there's also this downside protection at an inflation hedge because you're looking at relatively low correlated assets.
Yes.
I think that's the kind of key point. So it's sort of this new element or newer element in a lot of portfolios. And you're seeing a lot of wealth transferring into these sides.
That might be the most important point, right? And look, again, just happy accidents. I was super lucky. I got to go to business school right out of undergrad. You can't do that anymore. But back then, they wanted you to go into the PhD program at Chicago. And, and they know if you worked, there's no way you're going to take time off and go into the PhD program. So they let a few kids out of undergrad. And I got to take a class with Dr. Markowitz and with Gene Fama. And Gene Fama convinced me, no way am I doing the PhD. But taking a class with Dr. Markowitz was extraordinary because, this guy invented the capital asset pricing model. And he's the one that popularized what you just said that's so important, which is assets are great. And if they have a higher return, that's fantastic. But the key to success over the long term is finding assets that are uncorrelated with one another, because when you add them into a portfolio, your risk actually goes down.
Yeah, well said, Mark. And I think that reminds me of one of the books that I read this summer for my summer reading. Say what you will about this guy. I take some of the positives. I try to leave some of the cultish stuff on the sidelines, but Tony Robbins, he wrote the book Holy Grail of Investing, and he spoke a lot about this because he's basically following around Ray Dalio, and he talks about the Holy Grail of investing, which is exactly what you mentioned, finding these 8 to 15 uncorrelated assets to reduce risk while maintaining returns. And so basically, I had these uncorrelated assets, you can reduce risk up to 80% without sacrificing returns. So I think, that's such a great point that we can end on, is that we kind of look at all these areas of technology, because in the end, we're finding things that could push the overall market, but somehow be distinct from what's going on in equities, what's going on in bonds, and obviously within commodities. So it's an exciting job that we get to do more. And
yeah, and I'll create it on the spot, and it might fall flat, but we talk about the ABCDs, right? AI, blockchain, chips, and data, and any one of them is great. But A plus B plus C plus D beats E, beats everything.
I love that, Mark. I think that was well done and well said. For those that are watching college football this week at Notre Dame, you have the week off. Michigan fans, we're going to bite our fingernails a little bit more as we head over to Washington. Hopefully, we'll have a good game. But we thank all of our listeners for tuning in each week. Don't forget to rate, review, and subscribe. And we'll remind everyone, as we do every week, to stay current.
Thanks, X.
Thanks, Mark.
Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear.
And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.